Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Ronnie Stoeferle, Managing Partner of Incrementum AG. Ronnie, welcome back.
Hi, gentlemen. Good to see you again. Hope you're well.
Well, Ronnie, a lot's going on in the world, and of course, you're one of our experts in Austria in the European arena. The dollar has just reached parity with the euro, which is kind of interesting. That hasn't happened in a long time, 20 years. The euro seems to be falling apart. Gold's hitting new highs against the euro, isn't it? Lately. So what's going on in Europe? Why is the euro falling apart, and how is it affecting gold, precious metals?
Well, you know, um, actually, we wrote a book about that.
Yeah,
It's called the Zero Rate Trap, and I think it's crystal clear that we are in this rate trap. However, I think from a relative point of view, the US is still in a better position, and I really don't want to. Um, I don't want to say too many positive words about the Federal Reserve, but on a relative basis, they've done a much better job than the ECB. And I think over here in Europe, we are now faced with, first of all, spreads are widening. So I think there might be a new euro crisis emerging. People now really start differentiating again between German debt, so the bonds, and Italian debt, but also to some degree French debt, and other southern countries. Their bond markets were reacting very nervous recently. So there was Lagarde. She came up. She was warning against this fragmentation of the eurozone, and she wants to introduce a new rescue package. And we said it's probably be called Lira, which was the name of the former Italian currency, obviously. Perhaps it's that's an abbreviation for Lagarde's Inflation Recovery Act, or long-term interest rate adjustment, whatever. But it's clear that over here in the eurozone, many things are going into the wrong direction. First of all, they were even more behind the curve than the Federal Reserve. So they only start hiking interest rates now, while inflation is even more sticky than in the United States. Then, of course, energy is a big issue, and I have to tell you, I just came back from vacation, and it seemed like the last hooray where everybody said, well, let's go on vacation. Perhaps it's the last time we can actually afford it. Everybody is talking about inflation over here. If you talk to young people, to families, if you talk to retired people, it's affecting everybody. And it's a very scary situation, especially if we look a couple of months ahead, where I was, just a story from my private life. I was about to order wood for our oven, and the guy where we usually order the wood, he said, we don't have anything yet, and if we should get some, it will be significantly higher, because everybody just tries to to get some
wow.
wood for heating their homes, because Austria is importing like 80% of its natural gas from Russia. No, it's a scary situation, and therefore, it's i- i- those things that we have basically researched and forecasted already quite a while ago. They are now all happening at the same time: de-dollarization, inflation, stagflation, potential currency reforms, financial repression. It's really picking up momentum.
What you said about this new language that Lagarde and the European Central Bank is using to avoid fragmentation, is this like code language for, all right, we're not buying, okay, they want to end the buying of bonds and the QE. Germany and the Netherlands, they'd probably be fine with that. But if they don't buy the Greek, the Italian, the Spanishes, and the Portuguese debt, their rates are just going to skyrocket up to 7 or 10% for, if the private market has to fund their debt, no one's going to do it at 1 or 2%, right? The debt's going to the private market's going to demand 7 or 10% like they used to before Mario Draghi said anything it takes, right? So is that the big fear, that she's going to now favor the Southern bonds and Germany's
Yeah.
just, is that what they mean by this fragmentation, where they still got to buy bonds, but only the messed up bonds?
Yeah, that's it in a nutshell. And you know, when we had the euro crisis and the Greek debt crisis, you know, they were always talking about the death zone for the bond market. And you
The
know,
death
this
zone. Okay, what does that
this
mean?
death, you know, I think it was for Italian debt, it was like 6 to 7% yield on their 10 years, where they said, well, if we go above that, that's really becoming a concern for financing the household. And now I think this death zone is significantly lower, obviously, due to,
Much higher
we have
debt to
seen
GDP. Yeah.
some reforms, and actually what's been going on in Greece, for example, also in Italy. We shouldn't underestimate the reforms. So from my point of view, actually, I think France, but also, you know, the real center of the eurozone being Germany. Those are the real problem childs these days, and therefore I think, you know, that the ECB has tried coming up with a solution to this fragmentation. But I tweeted that out this morning from Joachim Nagel, who's the head of the Deutsche Bundesbank, and this was very, very strong language, very clear that they are against new policies to avoid this fragmentation, and therefore I think within the ECB, I think there's growing tensions, and of course, I mean, we're above 8% inflation rates, and we're still only thinking about raising rates. I mean, that's
It's kind of
you know,
crazy, isn't it? It's kind of
the
crazy.
wealth destruction that is happening. You know, you've got in equity and bond markets, and probably also real estate, and later on it's gonna spill over to private equity, and we've seen it in crypto markets. So you have this basically this everything bear market, and you know, portfolios in the first half of the year are down between 15 and 30%, and then 8% inflation on top. That's really serious wealth destruction that is happening. And of course, it has an impact on consumption. It has an impact on our behaviors as consumers, as investors, and also as business owners. So I mean, the thing is, and I think we're going to talk about that later on, Jim. Everybody is waiting for, you know, the Federal Reserve to hit the pause button, and then for the big Fed pivot. And I think we're closer now, but they they will, as always, be too late. And now at the moment, many people think that, you know, they will hike until something breaks. But I think so many markets are already cracking and have probably already broken, that it's already way too late.
Well, you said recently stagflation is here to stay. That was the title of a recent video you were interviewed on. And I guess that implies the Fed's probably going to fail. They're going to try to raise interest rates, but that's not going to kill it. If they don't fix the underlying problems, a recession and just raising rates doesn't fix inflation, right? It might go down a little, but it's not going back down to 2% is what you're saying, right? Or what do you mean by that? Stagflation's here to stay.
Yeah. Well. First of all, I have to say I was on a boat the last week, and I tried to avoid looking at markets. Of course,
It's difficult. Yeah.
It's difficult. but I try to clear my head and read and spend time with the family, and I had this sense that actually, this interplay between asset price deflation and consumer price inflation. That's really, I think, the most important um, paradigm to understand at the moment. And, and it seems to me that the market is clearly telling us, well, inflation, that's a thing of the past. So the thing is, the economy is already in a recession while inflation rates are coming down. But from my point of view, due to structural forces, I think we will settle at significantly higher lows than previously. So, so therefore, I think that our stagflation case that we made in this year's in Gold We Trust report, called Stagflation 2.0, where we actually we compared the 1970s to the current situation, and we differentiated what's different these days. And obviously the debt situation is the most striking difference. So therefore, I think that this stagflation environment is something that will be around for the next quarters and probably years. And then in the report, we crunch the numbers, and we try to analyze what actually works best in a stagflationary environment.
Well, that brings up the topic of gold, of course. You wrote the book on gold, and most people's their gut instinct would be, in a stagflation environment, that's a great environment for gold.
Yeah.
It was historically in the 70s, but here we are, gold is not performing. Have you had, what's different about this time from the 70s? Why is gold not doing what people are expecting it to?
Well,
or in euro terms, it is performing, though, in euro terms, much better than dollar terms, right?
Yeah. So I think this is really one important thing to consider. We have seen until recently, I think gold was up slightly in US dollar terms, but the US dollar is like a big wrecking ball, and it's wrecking everything all around the globe. We have seen this brutal bear market, not only in equities but primarily in the bond market. It's now spilling over to real estate markets, and as I've said before, private equity will be the next shoe to drop. Crypto is already impacted severely. So I think that gold, until recently, has done quite a good job of stabilizing your portfolio, and actually it held up pretty much okay. In euro terms, as you rightly said, it's up 8%. It's probably one of the very few assets that is up year to date. In Japanese yen terms, it's up 15%. So I think that the US dollar, the strength of the US dollar, is one of the major drivers. Then I think if you have a look at gold and real yields, I think that actually gold should still be $200 lower. So my interpretation would be that gold is kind of calling bullshit on the rate hikes, and it's already kind of sniffing out that that the Federal Reserve cannot continue on this path with rate hikes, but also very aggressive quantitative tightening. But Jim, to be honest, I would have, if you would have told me what's going on like 2 years ago, and then wanted me to forecast the price of gold, I would be a liar if I would have said, well, 1700. That's like what the price of gold should be. I would have said a significantly higher number, definitely. But it is what it is, and we have to look into the future, and I think the future isn't that bad for gold, actually.
Yeah, people are crying on Wall Street Silver. Well, we care about silver and to a lesser extent gold, but people are, do we just have to wait for the Fed to pivot? Is that the one thing that's going to be the trigger for gold and silver to really just launch at this point? Is the Fed doing a pause?
I think it. It is, and I think we all know, and I mean, if you study financial markets and especially the track record of the Federal Reserve, I mean, I think they didn't see anything coming over the last 18 months. Um, Jay Powell said, he actually doesn't have a clue how inflation is. I don't know his exact wording, but he doesn't
Yeah,
understand inflation, which is,
that
I
was a
think
funny
that's
that was a funny clip. We had that clip.
We now understand better how little we understand about
That's not very
inflation.
reassuring.
so I think that sums it up pretty well. But now that the question is, if they got it so wrong in the past and they didn't see anything coming, so why does the market still believe that they will get it right in the future? I mean,
Yeah.
it doesn't make any sense to me. And now the market expects 60 basis points of easing next year already. So basically, they say that the Fed will tighten so much over the next half year that it will cause the economy to roll over, um, but not into a brutal recession, but rather into a soft landing. This will result in economic weakness that will cause the Fed to ease next year. So Kevin Muir, my friend, said it's like racing to a stoplight so you can wait longer. It doesn't really make any sense. My game plan kind of is, I think we are already seeing a significant slowdown in the US economy. Of course, labor market is still, at least on the surface, holding up well, but I think that the ISM will go below 50 before the end of this summer. And historically, I think every time we went below 50, the Fed at least paused, or most of the time they started lowering interest rates again. So that's kind of my game plan. And I think as soon as this is happening and the market is realizing it, I think this will put in a low for the price of gold and also for the price of silver. But we shouldn't underestimate. It's also it's a confidence game. And Powell did pivot already quite often. And we remember 2018. We remember the Fed telling us, well, it's only transitory for such a long time. Now we're having the highest inflation numbers, for more than 40 years. So it is really about the trust in the Federal Reserve. It's about confidence in the system. And therefore, I think it will be a process. It won't be like one day or one moment, this pivot. It will be more of a process. And I think that I think the price of gold is already kind of sniffing that out. And if you have a look at commitment of traders report, for me, I have to say it's not for, how should I say, it's not decisive for me, but it's telling me where we are on the map. And it's like, if the cook, the chef has prepared dinner, everything is ready, a beautiful dinner, but he hasn't said, well, dinner is served. So that's how I would interpret commitment of traders report. I think it's a great setup. I think it's a very good risk reward.
And so then how does the Fed keep raising rates when Congress is trying to fight a recession with with fiscal policy? Those would be two contravening efforts.
Yeah, absolutely. And you can't have both. And I think it's gonna change. And we shouldn't forget, we've got elections coming up, obviously. And I think that Joe Biden's numbers are not that positive. I think they're falling faster than I don't know, tech stocks or whatever.
You break it down by age, 94% of Democratic primary voters under the age of 30, 94% say they don't want Biden.
So the thing is, if we have a look at markets at the moment, previously the economists were always talking about this wealth effect. Then they came out with this reverse wealth effect. So basically, killing financial assets to lower demand, and then basically getting inflation down. However, if we have a look at the numbers, it is quite a lot of wealth destruction that has happened. It is, I think it's 36% of world GDP that was basically wiped out. I mean, it's paper assets, but it still has an effect on spending behavior. So more capital has been destroyed in the past 6 months than in any previous bear markets. So this everything bear market, it clearly affects baby boomers the most. And if you're around 65, 67, whatever, you simply cannot afford such a weakness in asset prices anymore. So it has a tremendous effect on voters and on the elections, and therefore I think that they will try to pull out some sort of rabbit later on, probably late summer, and they will try whatever it takes to get markets up again. But of course, inflation numbers should be down significantly then.
Doesn't inflation just come roaring right back? I mean, if they start, like the Fed's current balance sheet is 9 trillion. I saw one estimate that by the presidential election in November of 2024, the Fed's balance sheet could be 20 trillion from their efforts to reinflate the economy.
Yeah, sure. And I mean, if you compare it to, the balance sheet to GDP, if you compare it to Japan or Switzerland, I mean, it's still way to go for the ECB and also for the Federal Reserve. And I think it would be naive to think that they will decide, well, let's take a laissez-faire approach, and let the recession happen. That's not gonna happen. Yeah,
they're gonna try to save it. Yeah, they're gonna spend.
But I think there was a great chart by the Macro Compass coming out, and it was showing the global credit impulse. So that's basically I think the 5 biggest economies and in which direction their credit growth is heading. And actually, it's going down even, it's contracting even more dramatically than during the great financial crisis. So I think, what is now really brewing, what the Fed has kind of reached with its aggressive policy that came way too late. I think it's gonna take much more than in previous crises to get things up again. And this is declining marginal utility of all those rescue packages. So I mean, let's face it, the next round of quantitative easing will be significantly bigger than the previous one. I think, when it comes to interest rates, I often said this will be the shortest and shallowest rate hike cycle in the history of the Federal Reserve. It can still play out, absolutely. And we should not underestimate what else they could do in terms of financial repression, yield curve control. All that stuff is still in the toolbox.
So last question, I'm gonna call you out for a prediction. We've got the Fed probably going to raise. Is this going to be the last rate hike that the Fed does before this rate cycle is over?
Tough one. I think they will start lowering rates in fall. I don't know if there will be 1 or 2 more hikes. I just don't know. But I think by late summer, early fall, they will at least start pausing.
Yeah.
But actually, Jim, the thing is, we're now talking for 25 minutes about the Federal Reserve in a healthy market. we wouldn't even know, what the Federal Reserve is really about to do. We wouldn't care, because then we would be talking about business models. We would be talking about ideas, about innovation, about companies. So this is it's not to criticize you, but it just tells a lot how dependent the markets are on Federal Reserve policy, on cheap liquidity, on ever falling interest rates, and more stimulus. And this is already telling me that, well, actually we're not in a healthy system anymore. And at some point, there will be a transition to a new monetary system. And we had an interview with the legendary blogger Fofoa in our previous In Gold We Trust report, and he said gold is actually a singularity hedge, and you want to hold gold for this transition period from one leading currency to the next one. And this is not a gloom and doom thing, but if you understand monetary history, and if I've got so many books here in my bookshelf about monetary history, and currency reforms just happen every couple of decades. And I think in the course,
are we due? We're due for a new system. The old one, we're all bored with the old system. It's time for a new one.
Oh, well, Jim, will we, I was just in Croatia, and they're introducing the euro beginning of next year, and I said, well, timing could be better.
Well, on that note, Ronnie, thank you very much for joining us. You're one of the best, and we really appreciate it. And I'm definitely going to call you in another 3 months and have you back on.
Thank you very much for inviting me, and we'll probably see each other in Beaver Creek at Precious Metal Summit.
Oh yeah, I will be there.
We'll have a beer together.
All right.